I'm happy to give you the keynote here in the economics today, talking about what I'm seeing in the real estate economy, and we'll talk more about it, but it's titled An Era of Unprecedented Events. But before we get going, my lawyer would be remiss, especially with Brad just talking, if I didn't give you a disclaimer. I'm not here to solicit you, I'm not here to give you legal documents, I'm just here to give you informational info only. First off, I've got a few of my teammates in the audience here. I'm joined by my co-founder, Tim Donovan, our newest managing director, Alyssa Geisler, and then he was here in spirit. He was going to join. I think a lot of you know my partner, Josh Kurznak, who's the CEO of Hempel as well. I don't need to talk too much about myself. You guys already heard a lot about me, but proud alumni here of Marquette University. I'm going on my 18th year in real estate. We can debate if it's been 2 or 3 cycles, but I've lived through 2. And I'm sure a lot more are coming. Overall, I'm a real glutton for punishment. My CPA absolutely hates me. I've got 55 K1s, but I'm just a sucker for a good deal. And as one of my mentors one time told me, though, the guy with the most K1s is doing okay in life. So I think we'll just keep doing that. And overall, as mentioned, I've done about $3 billion in transactions. I'll tell you a little bit about Midloch before we talk about the economics, but Midloch overall, we're a boutique investment fund manager. We do both apartments, industrial, retail, and sometimes we even use the 4-letter word of office, right? We try to hit a consistent 13 to 17% return, and as you can see, these are exited investments since 2019. We've done quite a bit better than what we target overall. You're probably like, I've never heard of this firm. What do you guys actually do? Well, I'm glad you asked. We are the firm behind the scenes. We do equity. We're the thing that everyone's basically looking for and doesn't quite know how to find. That's us. That's what we do. We play across the capital stack. We partner up with local firms. Some of them you mentioned, Harmonic, Interstate Parking, ICAP, my affiliate Hempel. We've partnered up with many of those firms and many more. We usually issue a check between $1 and $20 million of equity and structuring it as GP equity, LP equity, pref equity, mezzanine debt. We do it all here at Midloch. Oh, and then lastly, we've been doing a lot of rescue capital lately. That's a key thing to note. As mentioned, Wisconsin's one of our home markets where we were co-founded. This up here is a visual representation of everywhere we've done a deal in the state of Wisconsin since 2019. So needless to say, we're pretty bullish in the state of Wisconsin and look to keep doing so moving forward. All right, well, on to the main event. So you guys, I know Tracy gave you a lot of good data, and I'll do my best to follow up with that here. Unfortunately, we don't have enough time to watch TikToks all day, but what I did give you guys here is a screenshot. So I'm an elder millennial myself, and if you've done anything since the year 2000, you probably have lived through one unprecedented event after another, and you're not even sure if you should pay your bills. All right, so let me take you back. To get today's real estate economy, we need to go back in time to March of 2020 to figure out where we've been. So first off, you're probably just hearing about COVID-19 for the first time, and how do you solve a pandemic? Well, it's pretty easy. You just print a ton of money. And so as you see here on the screen, we decided to quintuple the money supply. By the way, this is not just one political party. Both parties voted for it, and both parties continued it, both the Biden and the Trump administration. So definitely a bipartisan issue here, printing money. There's been more money in circulation than there's ever been. So good times were had. People were having stimulus checks. You probably remember that. That guy looks pretty happy on the screen. That's our Federal Reserve Chairman, Jay Powell, soon to be outgoing. And yeah, he had his money printer gun going. He's kind of like Oprah. Everyone gets $1, right? So, and what happened as a result? Well, that money's got to come from somewhere, right? So we just kept printing, right? This is our national debt. And by the way, if there's one thing you notice that goes all the way back from 1970, it just goes up and to the right. Well, that led to inflation, which we can talk more about in a second. And good times were had for a long time. So this is a chart of the S&P 500. And in fact, I'm just going to go back. The reason I think that's important, if you just went back and forth, the S&P 500 basically mirrors our national debt. So that money's got to flow somewhere, and so, why not take our national debt and inflate some asset prices? Now, the market, they've had some bouts where they didn't always like what was going on. You know, that first red dot at the bottom, that's COVID-19. That's when Bill Ackman uttered the words, "Hell is coming." It was pretty scary. I remember sitting at home with my wife saying, I don't know what the hell's going to happen tomorrow. So, and then, in the middle, that big red dot, there was some taper tantrum, I should say. Interest rates kept going up. Nobody liked it. Oh, and by the way, a few banks imploded, Silicon Valley Bank, First Republic Bank. By the way, that would be locally, like we wiped out Wintrust Bank, Associated Bank, and maybe Johnson Bank for good measure. None of these were small, so it was definitely a big deal, but we kept going. Prices kept going up. And then more recently, that last red line, that is Liberation Day. That was Trump giving us the tariffs that were mentioned by Tracy, and that was supposed to cure all of our economic sins, which we can debate another day. So overall, if you say, hey, S&P 500 is doing good, we're printing a lot of money, we got a lot of debt, the good times must be had by everyone. Well, for every action, there's got to be a counter reaction, and so interest rates had to go up. And I know that's good if you're a bank, you want to see good high interest rates, but there has to be some counteraction to all that inflation and money printing. So you got two lines here on the screen. I'll try to keep it simple. The green line is the line the Federal Reserve controls. That's the Fed Chair Jay Powell and his board. And they kept bringing it up and bringing it up. And yes, it's come down a little bit. Another line is the 10-year Treasury. The 10-year Treasury is dictated by you, me, and everyone else. That is the market deciding what it should be. If there's one thing you can see, interest rates have doubled or tripled since 2019. And historically, it's not too bad, but it's not that easy if interest rates keep going up to make money in real estate. So this is a chart here right now that talks about the real estate economy and values. This is the Green Street Commercial Property Index. And so if you look at the 99, that's 2007 as a baseline. And if you went to the peak, that's about 150, give or take, in 2021. And so real estate generally, yeah, we've gone up and to the right for the last 15 to 20 years. But for the last 2 or 3 years, we've lost 20 to 30%. Apartments and office have sometimes lost 30 to 80%. So it's not one size fits all. And by the way, there was a lot of bad borrowing going on at the time. If you had 80% leverage, and you had 20% equity, you're wiped out. You're insolvent right now. You're bankrupt. And if you were one of the smart ones, you took less debt, you played it safe, well, congrats, you survived. But your reward for surviving is you now have double interest rates across your whole portfolio. So that's going to impact what real estate values are doing. So let me tell you what we're seeing in the marketplace. So with all that money printing, those asset prices and interest rates going up and that inflation, it's definitely leading to some of the things that Tracy already talked about. First and foremost, what we're seeing is there's zombie deals. This is the number one thing we talk about in the investment space. If you did a deal between 2018 to 2023, and I'm sure there's some people in the room, you're probably not proud of a deal you did. Maybe you haven't told your spouse you're bankrupt on a deal. There's probably a deal or two that you wish you could take back out of your portfolio. And this is common. I get calls on this all day, every day, and a lot of times it's not even investments that have anything to do with us, thank gosh, right? And so people are trying to figure out how they get out of zombie deals. Secondly, what we're seeing is there's a wall of loan maturities. And these are things that lenders, they know they're coming and they're doing their best to extend it just like they did in 2008 and 2009. But at some point, it's going to come calling. People can only be patient for so long, and those lenders are going to need to get paid off. And then lastly, liquidity is down. Now, I will admit the debt market's a little more healthy than it's been the last few years, a little more optimism. But debt is a Band-Aid. It doesn't solve your solution if you have too much debt by just taking on more debt. And so right now what we're seeing specifically at Midloch is equity it's hard to find. People don't have equity for these zombie deals, and we're going to have a reset. All right, let me give you a case study or two here just to kind of show you what we're seeing in the market and bring this a little more to life. And we're going to go property type by property type. First off, we'll start with apartments. And I always say this to some people. Sometimes I tell people that I know office takes the brunt of all the communication, but I think apartments are sometimes more distressed. They get all the good headlines about how wonderful they are. First off, I know this is known acutely in Wisconsin, but there's a supply overhang. It's really bad in the states like Texas, but even locally here, whether it be downtown Milwaukee or elsewhere, there just was too many apartments built. Now it's getting better. We're building less. Obviously, a lot of people know about the Edison just killing their project and, because we maybe have too many luxury apartments. So there can be a supply overhang, but it's getting a little bit better. We did talk about that second point about there not being money, but what we're seeing is some of these deals that got bought, they need to get capital called, meaning they need an equity infusion that we're just not seeing. And lastly, while we talked about the stock market being at all-time highs, it's really a two-tiered economy right now. And I see this in our own portfolio, even though we own really good stuff. it's really hard for your renters out there. They don't know if they should pay rent. They don't know if they should pay their bills. They'll pay their phone bill. They're not getting rid of that iPhone. But it's a tough economy right now if you don't have assets. I'll give you a case study here more specifically. This is one we did about a year ago in Sheboygan, Wisconsin. It was built for $42 million by an out-of-state developer. And I feel bad. They had $32 million of a senior loan, another $5 million from a mezzanine lender. Oh, and by the way, 19 banks shared that debt. That's like every lender's worst nightmare. Ultimately, we came in, injected some rescue capital, paid that loan down to about $22 million, and we bought out the mezz debt for about $1 million. Gave the old investors what's known in the business as a hope note. And this is where I think it's tough to have staying power. You always don't want to sell at the bottom or get recapitalized, but eventually you do. And since the acquisition, we've been able to fix some of the problems. The market, the supply problem's gone away a little bit, and occupancy's gone up to about 94% from 70%. All right, lastly, I like to show this to people to kind of keep it light. You know, landlords have had it tough. I'm sure everyone feels landlords have had a tough time out there, especially the apartment landlords. They do a lot to protect the renters. You know, there's only so many bullets they can take, and I think you should tip your landlord, in my opinion. So, all right, industrial. I do agree with Tracy that industrial generally has been the golden child, but there's still a few things we're seeing, and right now, if you have large space, there's still an overhang. I know vacancy is at low, but that's tiered, right? If you have a multi-tenant building or a smaller building that caters to smaller tenants, you're probably close to full. But if you've got a brand new building that maybe you built on spec, there's a good chance you might be half occupied or 80% occupied. And so we're seeing an overhang for really large spaces, anywhere from 40,000 to 500,000 square feet in space, looking for some of those bigger tenants. If you have small space, it's hot right now. You know, there's a lot of demand, especially if you have outdoor storage. Lastly, the point there says there's not the distress like you see in office and apartments, but there are discounts. We are seeing developers, they're quietly selling stuff at less than what they maybe built it for. Maybe they're eating into their developer fee. They just want to recycle that money. I'll skip this case study for the sake of time, but just know that there is deals out there to be had on the industrial side. Lastly, office, echoing a little bit of what Tracy said, there is a return to work. It is getting better, but it's still not been great. But I used to guest lecture at Marquette, and I would show this meme to the students here, and I think every landlord's worst nightmare is finding a tenant that wants no residual TIs that have no value. And one of the things we're seeing right now that's made office particularly hard is that tenant improvement dollars have gone to the moon. You know, $50 a square foot is really the starting rate, and $100 a square foot and up is becoming the norm. And by the way, I always tell my analyst team, buy a building for $0, plug $100 in TIs, and tell me if you still want to buy it. A lot of times the answer is you don't. So now, despite that negative news, I will agree that the trend is people are coming back to work. There is a return to work here. You know, Jamie Dimon's trying to get all of his people back in. I'll give you just one case study before I give you some final thoughts here. This is a building we bought from a local Wisconsin lender here that we bought for about $40 million. It's a tower in Minneapolis. Unfortunately, it was in foreclosure. We bought it for about 64% occupancy at the time. And for the first 2 years, I'll admit, we didn't get a lot of tenants. It was bad. Tenants were leaving. You know, we thought you buy at the bottom, you'll be okay. But it wasn't until this year that we've actually seen tenants start to come back. And that's with us putting significant capital dollars in. So I was going to tell you about retail, but I'm going to be honest, retail is very healthy. And so the only reason I didn't give you any case studies for retail is we've seen the best trends for retail that we've ever seen in the last 15 years. So if you're in the retail sector, I think you make a case that you're the best economic point there is. And some of that's having a supply balance because of Amazon. We just didn't build the last 15 years overall, and we're at a healthy supply and demand balance overall. All right, so things we're thinking about long-term at Midloch is that your basis matters right now more than ever. I do think that we've got a few more years of this slug to get through. We're not quite out of it. Inflation's not going away today, so you gotta be careful. Interest rates are abating, but I think if anyone's thinking about interest rates long-term, you need to plan that they're gonna be here to stay. I think going back to 3, 4, maybe even 5%, those days may be gone. And so you need to plan for interest rates to stay higher for longer. Who your lender matters here. I will tell you in Wisconsin, we're blessed with a lot of great banks, a lot of great insurance companies. And so that structure matters more than ever. I know the Wisconsin people aren't as keen to it, but you know, nationally there has been a big problem of a lot of debt funds proliferating, and that has caused a lot of these debt issues you've seen. And then lastly, for our side, we really believe you got to stay positive here. I'm going to go back to the same slide we just presented on, is while we're down here about 20%, we've got interest rates up, high inflation. Generally, this cycle, like everything else, it will pass. So with that, thank you.
So it's good to see everybody again. So my name is Andy Hunt. I'm the Executive Director for the Veith Institute for Real Estate Leadership at Marquette University. I've been lucky enough to know Andy for many years. I knew you as a student, which is kind of fun to think about. You've certainly amounted to a lot, Andy, from where I remember you back in the day.
Says low things about me, I believe.
So much good content, most millennial-friendly presentation we've ever seen. We've never seen this many memes in a BizTimes presentation, so thank you for that. I thought that was fantastic. Let's dive into something that you didn't get into a little bit, which is you talk to investors all the time. What are your investors saying amidst all this market uncertainty today?
Well, first off, a lot of investors right now, what I can tell you, they have bad deals in their portfolio, and so the first thing I hear is, I want to invest, but it's tough for them to move money around when the stock market's at all-time highs. It's tough to make real estate your top priority, and it's also been tough because a lot of them, frankly, they put money into real estate deals the last 5 years, and they've gone bankrupt. You know, I know they wanted to try. I talked to a guy yesterday. He said, I wanted to trust this developer. I looked at the building, I believed in it, and I lost all my money. Now, that wasn't a Midloch project. That was just kind of some group therapy, shall we say. But I do think they're going to come back, Andy, but it's going to take some time.
Yeah. The other issue that I'm hearing from some of these investors is, even if my deals are going well, there's not a lot of deals that are turning over and that are recapitalizing, or they're not getting their money back and to be able to redeploy. I mean, what are your thoughts on seeing that? Are you guys experiencing that yourselves? Tell us a little bit more about that.
Yeah, I agree with the point Andy Hunt here is making, is that overall, I do think that the velocity of the money supply coming back to investors matters. You know, even if investors reinvest their money, there's one investor I know that says, hey, every 3 to 5 years, I want to touch my money. I want it to come back to me. I want to date it. And then I'll probably put it in the bank account for a few days, and I'll flip you a check the next week. So I do think that velocity is down. And I think until we can get through this slog of where we are with interest rates, and frankly, Andy, that's going to come with people recognizing losses. And I think once we get through that and get to a better supply-demand balance and also a better interest rate environment where people just accept where interest rates are and stop hoping that, you know, the Federal Reserve is going to keep cutting, I think that's just a fool's game.
Let's stick with that a little bit. Deal flow is a really important question, inherent in what we just talked about a little bit, but reading the tea leaves, Andy, when you're looking out at 2026, are you seeing deal flow increasing? Are you seeing it remaining flat? I mean, this gets back to some of the CAR-W survey where, you know, a lot of people kind of feel like next year still should be positive. What do you feel?
Yeah, so I think deal flow really bottomed in Q4 of 2023 into Q1 of 2024. That was probably the absolute zenith of where things were, where people finally were like, you know what? I get it. It didn't work out. It was the first round of deals. If you had a 3-year loan from 2021, that things came due. So I do think that deal flow every year has got better. There's been more capitulation, more of this, I would say, just meeting the market for where it is. And so I do think if you look at 26, I do think it's going to be a good year to be a seller. I think institutional capital that was on the sidelines is coming back. And I do think that, you know, as you get momentum, you talk about the money supply and money moving, I do think all that momentum will be good.
So one of my favorite things about the work that you guys do at Midloch is being the, as you said, behind the scenes money. You're talking to sponsors all over the country or trying to bring these deals saying, hey, I need the capital, Andy, let's partner on this, let's do it. What are you hearing from them in today's environment? Maybe that was different from 6 or 12 months ago that could kind of help us understand what to expect moving forward. What type of stories are they telling, deals are they bringing to you, et cetera?
Well, my favorite is, I know I screwed it up a few years ago, but if you just give me another dollar, I'll prove what we can do. By the way, they didn't screw it up for us, but somebody else is their investor. So I do think that what you're hearing from sponsors right now is that even if you have a wound or two coming out of the last few years, I think people are cognizant that now is the time to start looking for deals. And I think there's a big optimism. You know, I think naturally as a real estate community, we are optimists and we're looking for ways to make money. And so I think it's across the board, Andy. It's a broad spectrum, but I think people are optimistic about occupancy. The only thing that people aren't optimistic about, which always makes me nervous, is people believe inflation is gone. And Tracy, you talked about it here with talking about energy infrastructure. My belief is that if you want to have a good infrastructure, you better be ready for double-digit increases to your electricity bill.
So I love being positive, Andy, but we got to look the other way for just a second. So you talked about zombie deals. You've talked to us about interest rates today. You've talked to us about inflation. One of the things that I know you do is really follow what the institutional investors are doing. And recently, we've started to see data that the allocation toward real estate from these big institutions is starting to come down a little bit. And that tells a really interesting story about how the biggest investors in the country are thinking about the future of commercial real estate. When you saw some of that, what did that make you think? What would you want this room to know about those smart investors and the moves they're making?
Well, first off, I think there can be smart money if you talk about big, large investors. But I personally think you want to be buying when no one else is, Andy. So I think it's probably okay that some of the money that has maybe been there and over allocated when times were maybe too good have left. So maybe it's a good time to buy stuff up on the cheap, as we've done at Midloch. But I do think, furthermore, they're just reallocating, right? They're rebalancing their books. The big trend right now that I told Andy here last week as we were prepping for this is there's a lot of money moving to infrastructure, and rightfully so, right? We've got data centers, AI, all these other things. Money's going to chase whatever the hot topic is. What we have to do at Midloch is just stay consistent. Mm-hmm.
So, I'm looking at these sponsors. I want to go back to them for just a second because I appreciate the optimism around. There's a reallocation. It's going to happen, and I understand that. And you guys are going to keep chasing deals. I know that you are. When you are looking at the deals that you're starting to see from sponsors, what are the good ones these days? What are the ones that actually get you excited? Are you seeing as many of them as you used to, or are you actually starting to see more?
Yeah, I think in terms of where the investment is, I think this is the best time, Andy. It's funny, I was at a different conference as a panelist, and it's funny, there was 4 panelists, and the moderator asked, what do you think about the environment? I was the only one that got up and said, this is the best time to buy in the last 5 years. And so even though I maybe probably gave you some bearish data here, I do think that I think right now, Andy, the basis on stuff is as good as it's ever been. Yeah. The stuff you can pay for industrial, it's as good as it's ever been, especially for good quality stuff. So where we're seeing opportunities is you can pay a price that you previously had to pay for a Class B or C building. You can get that for Class A right now. And Class A is on sale. And that's because we've got developers that need to recycle their cash.
Even in office?
Oh man, that's the 4-letter word. It remains to be seen. I will say, if you're a true contrarian, now is the time you should be buying office. I do think the money has flowed into office, the last 2 years especially. Cap rates are up on office. Granted they were at a 15 and now they're at a 10. So, hey, you gotta go somewhere, right? But the one thing with office that's still scary is we have to, as a society, we got to find a way to get tenants to maybe not expect as high of tenant improvement costs and maybe renew their leases a few more times.
Yeah, there's clearly, it feels like there's more room to run. I really like that you pointed out that the return to office seems to be really impacting. I'm sure there's a lot of opinions about that in this room, which is good fodder for the happy hour at the end of today.
Totally.
Another really interesting thing I'd love your take on, LA, and maybe it was California altogether. You spent time in California.
I did.
Early in your career, I know you were in Sacramento with Palmer Capital, so you know the state somewhat. They announced that they really wanted to make affordable housing easier to develop. This is pretty recent. So now you have this, let's lower the bar in terms of how many steps we have to go through to approve affordable housing. And California is saying that, right? So later today, we're going to have a little bit of discussion around public policy and maybe some decisions that we can make at the city or county level or regionally. Tell us a little bit about what you think we should do. Should we be having policies like that to make it easier for affordable housing to happen here in Milwaukee? Or do you think that because we're starting to get oversupplied, the market's going to naturally take care of that with keeping rents pretty affordable, which they kind of are on a national basis, right?
Yeah, I think what Andy's referring to is California had a policy that basically let developers kind of override some of the local municipalities and zoning communities to basically allow them to build more housing, right? Well, I don't know all the specifics of the bill. I did comment to my co-founder, Josh Kurzak, said, wow, that's like a very Republican thing that California did. And he said, no, it's not Republican or Democrat, it's a very pro-housing thing that they did. And so I do think that regardless if you're which side of the aisle you lean, I do think that policies like that are pro-housing. You know, it's a side of two things. As a real estate investor, you actually don't want more housing because you want supply and demand to be in balance, right? Because if you have too much housing, it's not good as an investor. Now, if I take away the investor side of my persona, if you want cheap rents or if you want cheap housing, we should want as much housing as possible. It's been proven to work in areas like Austin, Texas. Now, it's not been a good investment market. On the flip side, unfortunately, it's been proven time and time again, even if you want rents to stay stable, unfortunately, rent control just hasn't worked. And I'm a big proponent of that. It doesn't make you lean Democrat, it just hasn't worked.
Mm-hmm. Okay, so we have to hit at least one thing related to AI. That's on everyone's bingo card today. So we're seeing a lot of these data centers. I know this is not necessarily your specialty area, but I could not help but notice that in the CarW survey, 70% of the members are worried about what these costs are going to be from an energy standpoint, and or that we don't have enough energy to supply this future demand for it with these data centers that are coming in. Your general thoughts about that? I know you think big about these things.
Okay, so I've got a brother who's a computer engineer. So he builds microchips, and there's a theory, a law, if you will, in computer hardware known as Moore's law, that says every 2 years that the amount of capacity on a microchip is going to double. And by the way, there was a similar theory on the food supply. I'm blanking on the name of it as well. And Moore's law has proven true, which basically the amount of transistors added to the microchips has doubled every year, year in, year out. And while I know we haven't quite had the same success with batteries and some other energy sources, I do believe that our efficiency and our ability to increase the grid capacity, I do think that it's going to take some political willpower on both sides of the aisle to maybe modernize some of our infrastructure. That's more than just the plants, that's stuff that carries the power lines. So I think data centers, look, it's a tough topic because I think we can all agree, maybe not the most politically or the best thing for our environment, but the data centers are the wave of the future. And so we're going to have to find a balance, here as a society, or we're going to have to stop using ChatGPT and making memes.
At least not saying thank you to ChatGPT, right? Because then
please stop saying thank you. But when the computers take over, they'll remember if you said thank you.
There we go. And on that note, please join me in thanking Andy Sinclair for being here today as our moderator. I appreciate it, buddy.